Hello friends. We started with cash flow statement, right? So what is a cash flow statement? It is the record of inflow and outflow of cash. Record of inflow and outflow of cash, right? And in the last lecture we started with cash flow from operating activities. What are the three activities we prepare cash flow statement? Operating activities, investing and financing. Okay. In the last lecture we started with operating activities, isn't it? So what is a operating activity? What is an operating activity that we discussed in the last lecture? Any activity related to the routine operations of the business. So I can say these are the routine activities of the business. Any activities which are related to the routine operations of the business are known as operating activities. Clear? For example, sale of goods for cash, purchase of goods for cash, salaries and wages payable. Anything that is done in the normal course of business, right? That is an operating activity. Any activity that is relating to the routine operations of the business is our operating activity. This is very important to be kept in mind, right? Because this is what we will use while identifying the items which will be covered under the operating activities and which will be covered under other activities. Clear, friends? Okay. So now what we are going to discuss in this lecture is, okay, one more important thing before this. While preparing cash flow statements, write this down. While preparing cash flow statement, we have to consider only those items. We have to consider only those items while preparing cash flow statements. We have to consider only those items which involve actual cash inflow or outflow from business, right? For example, you have rupees 100 in your pocket, right? And you decide that I will buy a 50 rupees notebook tomorrow with this 100 rupee note. But if you talk of today, have you spent rupees 50? You still have rupees 100 in your pocket. There is no outflow as of today. Tomorrow you will buy rupees 50. Tomorrow will be an outflow of 50 rupees. But today we can't say that. It is in your head only that you have to buy a notebook of rupees 50. But there is no actual cash outflow from your pocket. You still have rupees 100. So while preparing the cash flow statements, we have to consider only those items which involve actual cash inflow and outflow. Right? Right? This is very important. Okay? Now, next. What we are going to do in this lecture is steps in preparing cash flow statement. Steps in preparing cash flow statement from operating activities, right? And what are operating activities? The activities which are related to the routine operations of the business, those activities are known as operating activities. Clear? Now let's go back to understand this. Let's go back to class plus one. In class plus one, you prepare profit and loss account, right? You prepare profit and loss account. How you prepare profit and loss account? Right? You will say, sir, it's very simple. We all know how to prepare profit and loss account. Here you have gross profit, right? Here you have other incomes, right? On this side, this is your debit side and this is your credit side, right? You have gross profit, you have other incomes, then you subtract expenses from this side and what you get is the net profit. Isn't it? I hope all of you know the steps in preparation of profit and loss account. You take gross profit, you take other incomes, you subtract expenses and what you get is net profit. Now if you see this gross profit and other incomes, what is this? This is your, I can say them, cash inflows. Isn't it? And what are the expenses? I can say them cash outflows. What is the result? Net profit. Net profit shows what is the result of net of cash inflows and outflows. Cash inflows minus cash outflows reflect the extra cash that we are earning, right? Cash inflows minus cash outflows is what we get as net profit. Clear, friends? Clear this much? We prepare profit and loss account. What we get? Gross profit, other incomes, expenses we subtract. We subtract cash outflows from cash inflows and what we get is net profit. Right? Now, the additional thing here is on this net profit, you will pay a tax. Say at the rate of 30%. You will pay tax at the rate of 30%. This is what you will get. Okay, I'll just write down here. Okay, you got net profit from the profit and loss account. Okay, just forget this. Okay, you get net profit from this profit and loss account. I can write this net profit as net profits before tax. Clear? Say 5 lakhs. Now, the government says if your profit is this much, you will have to pay tax on this. Right, sir? So, we'll pay tax on this, say 30%. 1,50,000. How much is the net profit after tax? 3,50,000. This means that you can't say that I have pocketed 5 lakh rupees. 5 lakh rupees is not the amount that has come into your pocket. Right? What is coming into your pocket? 3,50,000. Right? So your pocket is now having 3,50,000. Then you suddenly realized that during the year there was an extraordinary expense. What is an extraordinary expense? Because of floods, there was a loss of stock amounting to 1 lakh. Because of floods, there was a loss amounting to 1 lakh. Will it happen every year? No, sir. Right? So this is our extraordinary expense because of some extraordinary reason out of the control of the business. Sir, we have 3,50,000, but we have to account that extraordinary expense also. So extraordinary expense, say 1 lakh. So what is the actual amount that you have pocketed? 2,50,000. Clear? Now you have profits of 2,50,000, right? This is net profits after tax and extraordinary items. I will write them as net profits after tax and extraordinary items. I hope this much is clear to you, friends. I simply prepared profit and loss account. From there I got the net profit. Now on that profit I have to pay tax to the government. So I pay tax at the rate of 30% amounting to 1,50,000. So what is the actual amount that is coming into my pocket? 3,50,000. But during the year there was an extraordinary event that resulted in an expense. Now I have to pay for that extraordinary event also, 1 lakh. So what is the actual amount that is coming into my pocket, that is left in my pocket? 2,50,000. Right? Now what you decide is you have 2,50,000. Okay. You say that I have the profits in the next year. What you say is I have profits of 2,50,000. Let's make a next year also I will have to pay the tax. So why not prepare a provision for tax? Right? Out of this 2,50,000, you decide to have provision for tax. Okay, sir. This is just a provision. You are not paying tax here. This is just a provision of tax. Right? Like you have 100 rupees in your pocket and you are thinking that you have to spend rupees 50 on buying a notebook. This thinking is provision. You are creating a provision in your mind that you have to pay 50 rupees for the notebook. Here also the business is creating a provision in his mind that they have to pay tax next year. So why not create a provision? What is provision? Creating provision. It means setting aside some amount for that specific purpose. So that business decide that we will say 1 lakh. Right? So this way there can be many things that they can use 2,50,000 for. Like for provision for tax, this can be used for paying dividend to shareholders. Dividend is paid to shareholders. So this money can be used for paying dividend to shareholders. Right? Now, coming to the cash flow. I hope this much is clear. We prepare profit and loss account, we get the net profit. On this net profit is what is our income. On this net profit, we will pay tax at the rate of 30%, say 1,50,000. So what is the actual amount coming to my pocket? 3,50,000. But during the year, there was an extraordinary expense, right? 1 lakh. So what is the amount left in my pocket? 2,50,000. Now this 2,50,000, I can use it in various ways. I can create a provision for tax for the next year, right? I can pay dividend to the equity shareholders, or I can do it in any other way. Now coming to the cash flow, if we talk of cash flow from operating activities, right? We'll talk of cash flow from operating activities. Right? Now, what is the first step in this? Step 1. Step 1 is calculate net profit. Be careful in this. Calculate net profit before taxes and extraordinary items. So what is the first step in the preparation of cash flow from operating activities is we have to find out the net profit before taxes and extraordinary items. We have to find out this amount of 5 lakh. Clear? So now what you will have is what you will be given in the question. You will be given this amount in the question. You will be given this amount in the question, net profits after tax and extraordinary items, and out of that even the provisions can be subtracted. Provisions could be subtracted in question. Right? Now, what you will be given is net profits after tax and extraordinary items. Right? Now, what you will do is there are 3 cases in that. Right? In the calculation of net profit before taxes and extraordinary items, we have 3 cases. Case 1. We can be given net profit in 3 ways. What is our ultimate aim? Our ultimate aim is to reach at net profit before taxes and extraordinary items. Right? So case 1 is we are given profits after tax. Profits after tax for the year. What we are given is profits after tax for the year. This is what we are given. Or we can say this also. Either this will be given or this will be given. Right? So what we are given is profits after tax and extraordinary items, I can say. Profits after tax and extraordinary items for the year. Now, what you are going to do is how to reach at net profit before tax and extraordinary items. We will have to do the reverse working. From here to here, we have to reach here. So, whatever is subtracted, we will add back. You know how to do reverse working. Right? Whatever is subtracted, we will add back, and whatever is added, we will subtract. We have to move in the reverse direction. Right? Now, profits after tax. These are given to us in the question. Right? Now, see, if there is an extraordinary expense, what we did, we subtracted. Now if we are doing the reverse working, what we will do with this extraordinary expense? We will add back in this profits after tax. We will say add extraordinary items debited, right? The expense that has been debited as extraordinary items, we will add back, right? Anything else we will add back? Friends, if you are given in the question provision for taxation for current year, for the current year, we made a provision, right? We made a provision out of the profits, provision for taxation. Now, I told you that we have to consider only those items which involve actual cash inflow and outflow. So, does the provision, creating provision for taxation, is creating an actual cash outflow or inflow? For that particular year, for the current year, we are creating a provision for tax. But is it involving an actual cash inflow or outflow? Just tell me. I told you that you have 100 rupees in your pocket. You are creating a provision in your mind that you have to spend 50 rupees tomorrow on buying a notebook. Is this creating provision in mind involving an actual cash outflow? No, sir. Right? So if we are given provision for taxation, we will add back any provision created out of the profits because it does not involve an actual cash outflow. Provision for taxation. Clear? So this is the amount that we will get. What we have to subtract is here provision for tax we have added. What we will subtract is if we get any refund of tax. If we are getting any refund of tax. Why we subtract the refund of tax? Is it an operating activity? Is this activity relating to the operations of the business? No. So what we are doing is we will subtract refund of tax. Clear? Because this refund of tax would have been added in the profits after tax for the year. So we will subtract the refund of tax because it is not an operating activity. What else can we subtract? Here I told you if there is an extraordinary expense, we will add back. But if there is an extraordinary income, if there is an extraordinary income, we will subtract that. What is an extraordinary income? Due to the floods, your stock was lost. That was an extraordinary loss. Right? Now, for that stock, you had done the insurance, you get the insurance compensation, that is your extraordinary income. Because it is not a routine income, that income is because of some extraordinary reason. Clear? So, if there is an extraordinary expense, we will add back because see here we have subtracted the extraordinary expense. If there would have been an extraordinary income, then I would have added back in the net profit. Clear? Very simple basics. So if we are given the profits after tax for the year, what we are going to do is we will consider profits after tax. We will add back if there are any extraordinary expenses. We will add back any provision for tax created for current year. Provision for tax for current year. Right? This is important. For provision for tax for current year. Clear? For the current year, if we have created a provision, today you have rupees 100 in your pocket, tomorrow you have to spend it, but today there is no cash outflow. isn't it? But you have subtracted your profits. There is no cash outflow, but you have reduced your profits without any cash outflow. So we will add back provision for tax for current year. What we are going to subtract is any extraordinary income like the insurance compensation received against the loss of stock. That is an extraordinary income. That is not happening. This income is not earned from the routine operations of the business. So we will subtract that income. Any refund of tax, this is not a routine operation of business. This is not a cash flow from the routine operations of the business. So we will subtract this refund of tax. Clear? So what you will get finally is net profits before tax and extraordinary items. Clear? This is how we will reach at profits before taxes and extraordinary items. For the current year, there is no tax paid, but there is a provision for tax, right? You will say, sir, why didn't we consider this amount, tax at the rate of 30%? This is the provision for current year. In the current year, until and unless we reach at the close, we prepare profit and loss account, we do not reach at this tax amount. What we do is we are just creating the provision for tax. So that provision of tax we will add back. Clear? So this is case 1 where profits after tax for the year are given. So second case is case 2. Case 2 is profits before taxes but after extraordinary items are given. Now friends, what will happen is, if you look at this example, in the normal course, if there is any extraordinary expense, we will record here only. We will record in the profit and loss account only, right? It was just for to clear you people that I took it here, right? So now, profits before taxes but after extraordinary items are given, right? If we have the profits, that means they will be after the extraordinary items only, because we have the profits from profit and loss account, and I told you that extraordinary items will be given in the profit and loss account only. If that is an expense, we will show it on the debit side, and if that is an income, we will show it on the credit side, right? Now, how to calculate that? You will say, sir, we have the profits before taxes, so nothing to do, right? But what we need is, we need net profits before taxes and extraordinary items. So we will have to give effect to the extraordinary items. What I will say is profits before taxes, profits before taxes. Now, if there is an extraordinary expense debited in the profit and loss account, that would have reduced my profits. Now I am doing the reverse working. What will I do with the extraordinary expense? I will add back extraordinary expenses, right? And what will I subtract? I will subtract any extraordinary income. Because friends, what we want is, I want to know the cash flow from my operations, from my routine operations of the business. Is earning this extraordinary income a routine operation of my business? Definitely no. I will subtract it. Simple. Right? Is this expense, extraordinary expense, related to the routine operations of my business? Absolutely no. I will add back this expense in the profits. Clear? So, anything else? We will subtract refund of tax. This you must remember, refund of tax, okay? So what you will get is net profits before taxes and extra ordinary items. Clear? I hope these two cases are very clear to you. Case 1 is, we are given the profits after tax for the year, right? We are given the profits after the tax for the year. We will add back any extraordinary items debited to the profit and loss account. Extraordinary items we will treat in the profit and loss account only, right? So if we are having the profits, that means we have already adjusted those extraordinary items in the profit and loss account. Clear? So we have profits after tax for the year. Profits after tax we will add back any extraordinary items debited to profit and loss account, right? Then if we have created a provision for tax for current year, for the current year we have created a provision that we have to pay this much tax approximately, we set aside the amount out of the profits. But does that involve actual cash outflow? You are just creating a provision. It is just a book entry, friends, nothing else. You are creating a provision in your mind that you have to spend ₹100 that you have kept in your pocket to buy a notebook tomorrow, right? But right now, today, is it involving any cash outflow? No. So we will add back any provision for taxes created for the current year. What we will subtract is, we will subtract any refund of tax because that is not an operating income for us. We will subtract any extraordinary income because that income is not earned from the routine operations of the business, right? Then the balancing figure we will get is net profits before taxes and extraordinary items, right? If we are given profits before taxes, right, even if in the question this line is not written, right, even then it is to be assumed, not assumed, even then it implies that extraordinary items have been either debited or credited in the profit and loss account, right? So how you are going to treat that is, profits before taxes you will add back any extraordinary expense because this expense is not related to the operations of the business. Clear? And you will subtract any extraordinary income plus the refund of tax you have to subtract because it is not related to the activities, it is not related to the routine activities of the operations. It is not going to affect the operations of the business, right? So this is how you will reach at net profit before taxes and extraordinary items. Clear, friends? So what is the first step? The first step in the cash flow from operating activities is we have to find out the net profit before taxes and extraordinary items. We have case 3, right? Case 3 we will do in the next lecture. First go through these two cases. If you have any doubts, right, out of these two cases, if you have any doubts, email me, right, at ksjteaching@gmail.com, right? Just remember two things while you are doing this cash flow from operating activities. Just remember two things. That is that an activity related to the routine operations of the business or not, right? So accordingly we will add back or subtract that. If we are earning an income, see if that income is because of the routine activities of the business or not. If not, subtract that income. Simple. Clear? This is very, very, very important to be kept in mind. The second thing important to be kept in mind is whether that activity is involving an actual cash inflow or outflow. You are keeping rupees 100 in your pocket. You are creating a provision in your mind that you have to spend rupees 50 on buying a notebook tomorrow. But today that provision in your mind is not actually a cash outflow. That is just a provision, right? So we cannot reduce our profits by any provision. We will add back the provisions created. Any activity which is not involving the actual cash outflow or inflow, right? So that activity has to be eliminated, right? If you are having 100 rupees, you have created a provision of spending 50 rupees. Today you can't say that you have 50 rupees in your pocket. You still have 100 rupees in your pocket. If your parents ask, what is the amount you are having in your pocket? You can't say I'm having 50 rupees because I have created a provision of 50 rupees for buying a notebook tomorrow. You still have 100 rupees in your pocket. Clear, friends? Is that clear? So these were the two cases regarding calculation of net profit before taxes and extraordinary items. In the next lecture, we will do the case 3. In the next lecture, we'll do case 3, right? We will be given balance of reserves and surplus, right? In the first two cases we were given the net profits, but in the third case we will be given the balance of reserves and surplus. Surplus is what? Profit only, nothing else. Reserves is what? We are setting aside some amount out of the profits only, isn't it? So reserves and surplus represent the profit only. We will discuss this in detail. We will discuss the items that have to be added back and that are to be subtracted from the balance of reserves and surplus. That we will discuss in the next lecture. Clear, friends? So that's all for this lecture, friends. Thank you so much.